Okay, welcome to the September 27th edition of the Fats, Fuels, and Oils webinar. This week will be probably a little bit shorter than most of the weeks, just because I haven't posted the reports yet, and honestly, I'm gonna try and get them done today, but it may not be today. It may not even be tomorrow, and might be later, and maybe not even there may not even be a report this week. For those of you that don't know, I live in Florida, and essentially I live just a very little bit south of where Hurricane Ian is projected to make landfall. So there's some chance that bulk of my day will probably be spent getting ready for that. And so I will try to get some reports posted, but if we lose electricity and it's out for a while, it may be a little bit before I'm able to do that, if I'm able to do it at all. So I apologize for any inconvenience and ask you to bear with me. All right, with that said, let's get going. And what we're going to talk about, not really a lot has happened over the past week, although despite that, the market has moved pretty substantially lower. Soybean oil futures were down about 2 cents, I think, and basis was down that much or a little bit more. And what we're going to talk today about is we're going to revisit the Argentine upriver basis, because I still think that that is probably playing a role in some of the basis changes that we're seeing. And then the other thing that we're going to talk about is the composition of RBD basis and how I expect that to shift over the next 6 months, and certainly over the next year. So outside of that, the main thing that we're sort of looking forward to now is the fats and oils report that will be released on Monday. And we expect that that will show a slight decrease in soybean oil stocks this month relative to the last month, maybe about 100 million pounds or so decrease month over month, and a little bit below where we were last year as well. And we expect stocks will kind of continue for the next month to the end of this month, September. We'll get data on Monday for August. But then we think that as crushing ramps up, that soybean oil stocks probably build, and they could potentially build to as high as about 2.7 billion pounds in the first quarter of 2023, as sort of the seasonal peak in crushing activity runs from sort of October, November, December, and then stays relatively high, obviously, in through the first quarter. I think that last night when I was looking at this and sort of getting ready for the webinar, the one question that I had about the stocks forecast is, well, maybe crush will just be lower, because if we have 2.7 billion pounds of soybean oil, we don't really need to crush for oil. Stocks should be sufficient to meet the demand from renewable diesel production, even given our assumptions about growth in feedstock demand. And so I went through in pretty good detail on my domestic soybean meal demand forecast. And I was a little surprised that it came out as strong as it did. I think I am now above where USDA is, or USDA was in their September WASDE. And in fact, if you bear with me here just for a second, yeah, they were at 39.2 million short tons, and we're at 39.675 million short tons. And the main driver for that really is growth in both hog and broiler slaughter. And those are two of the bigger consuming categories, with broiler being the largest soybean meal consuming category. And so we expect that hog slaughter will rise modestly 0.1% essentially year over year, but broiler slaughter will rise 4.2% as the industry kind of recovers from last year's severe bird flu outbreak. And so more birds is more meal demand, and with relatively not super conservative, but I think not crazy forecast for meal demand, I think that you could continue to see crushers essentially crushing for a meal, and that building soybean oil stocks to the levels that we expect. 2.7 billion pounds would be the highest number that USDA has reported since it started it started publishing the fats and oils report, but it would be below where the last Census Bureau report was. And so for those of you that are new to agriculture, for a very long time we got a lot of our soybean oil supply and demand data from a Census Bureau report, and then they discontinued that, and there wasn't anything for a little while, and then USDA started to publish the fats and oils report. So it would be a record for the fats and oils report, but the last Census Bureau report was 3.1 billion pounds. And so from that perspective, 2.7 billion pounds, while it's obviously really large, is not unheard of compared to what we've seen in the past. And there may be differences in methodology that mean that 3.1 billion would actually translate into a different number. But I think the message still is that while 2.7 is large, it's not out of the realm of possibility. In addition, if you just kind of look at the year-over-year growth that we had between last year and this year, and then this year and what we're projecting for next year, that kind of lines up. Now, the obvious caveat to all of that is that the growth in renewable diesel demand from last year to this year is not as strong as we expected to be from this year to next year. So while we're projecting 2.7 billion pounds, it wouldn't necessarily surprise me if stocks were a little bit tighter than that, but I don't think that we'll get dramatically lower stocks that would suggest that soybean oil prices or soybean oil basis needs to rise sharply to ration demand, despite the fact that soybean stocks themselves are probably going to be relatively tight, at least by the end of the 22-23 marketing year. Obviously, after harvest, there will be enough soybeans around to crush, but just in terms of crushers' decisions, whether, or I guess the ABCD's decisions, whether to crush soybeans or to export soybeans, one, I still think that they probably will favor crush over exports. And so if we are going to have a smaller crop, and we've talked about this before, if we're going to have a smaller crop, my preference would be to reduce exports more than I reduce crush. And all of that just means that while maybe 2.7 billion pounds may end up being on the upper end of sort of the range of possibilities, and I don't think that that's true. I think it's in the middle or maybe slightly higher than the middle. It means that it's probably not going to come down that much, even if we get a smaller soybean crop. The thing that would make me take those numbers down would either be an obvious jump in feedstock demand above where we're expecting, which is not something that we've seen over the last couple of years, despite the build out that has occurred so far in renewable diesel demand. And we've got a relatively robust expansion built into our forecast now. or a significant change in our slaughter forecast. I think if our slaughter forecasts were revised substantially lower and we got to the point where we didn't necessarily need all of the soybean meal and we're building these huge soybean oil stocks, then I would probably start to cut my crush forecasts a little bit more than otherwise. Okay, so let me show you. Let's first talk a little bit about, or let's revisit the export basis. And so as you can see, Argentine export basis continued to drop in the past week and is now nearly 20 cents below the nearby futures contract. And I think that it does a couple of things. One, it makes the Gulf obviously less competitive. You can see the spread between Argentine soybean oil exports and Gulf exports or basis. And I think that then has some knock-on effects that maybe we're starting to see in domestic basis. And so if the Gulf isn't competitive, then in theory, the soybean oil exports out of the US Gulf should not be that robust. And that backs a little bit of oil up into the domestic market. Now, I don't think we're talking about huge volumes here because we didn't have big export projections built into our forecast for September. But given where soybean oil stocks are right now, which is 2.2 billion pounds, call it, every additional pound just kind of adds to that stockpile. And so I think that that maybe part of the reason that you saw a decrease in RBD basis this week is because of the relative competitiveness of the Gulf compared to Argentina. I don't think that's the complete reason why, and I think probably in addition to whatever impact that is having, the other part of the impact is the shift that we expect to happen in the composition of RBD basis. And so this chart shows basically crude degummed basis and the refining margin stacked on top of each other so that you get RBD basis would be the top purple line there. And then the components obviously below that. So what you can see is that before a year and a half ago, before April 2021, pretty much, the RBD basis kind of ranged between 3 and maybe 5 cents or a little bit below that. And crude basis kind of was a little negative or maybe just a little positive, but didn't change that much. And then obviously starting in, I guess maybe starting a little bit earlier, starting in December, January timeframe, crude basis started to rise. You still had the refining margin relatively steady or maybe even shrinking a little bit as crude degummed basis rose. But then people started to talk about a shortage of refining capacity, and you had an explosion in RBD basis driven mainly by a sharp increase in the refining margin. And so that has been sort of the environment that we've been in, as you can see, like I said, over the past 18 months or a little bit longer than that. So the question is, what does this look like going forward? And I think that there are two parts to this. One, what does RBD basis look like? And then two, how much does crude degummed account for whatever that RBD basis number is, and how much does the refining margin account for whatever that basis number is? And one of the things that I've been trying to figure out is that question exactly. I think it's very easy to say broadly that that crude degummed basis will tend to rise as the expansion in renewable diesel capacity continues to be built out with pretreatment. So we think that about 90% of the new plants will have pretreatment, and as a result, instead of buying RBD soybean oil, they'll buy crude degummed soybean oil and refine it to their specs at their plant. And that should provide some relief on the refining capacity shortage. Now, I've tried to figure out exactly sort of where I think the refining capacity is and where the demand for RBD is, and gone through a similar exercise for crude degummed, and it looks like probably in 22-23, the refining capacity will remain a little bit tight, but not probably quite as tight as it was in 21-22. And so I think that means, and what we've seen really is that the refining margin has come down, and it's fallen below 10 cents for the first time since it started to really move sharply higher in April. You can kind of see, well, you can't really tell from the chart, but the refining margin has kind of tested the 10-cent level a couple of times during this period, and each time it's kind of bounced up. Now, last week it actually fell down to 9 cents, and again, that was the first time that it had fallen below 10 cents since April or March, sometime in there, I think April. So I think we probably will continue to see the refining margin shrink. I don't know that we'll get all the way back down to sort of the 3 or 4 cent margin that is the long-term historical average, in part because even though we may get to a point where we have more RBD refining capacity than we have RBD demand, the amount of crude degummed demand is going to rise and take up a bigger portion of the total capacity. And so if you look at sort of crude degummed demand relative to refining capacity over the last several years, it has accounted for maybe 40% of capacity, and that's going to rise up to 55% or so of capacity in 23-24, or that, at least that's what we're projecting. And so that then effectively reduces the amount of capacity, even if it's RBD capacity, that's available to process RBD, because it's processing crude degummed. And that means that I think that, again, crude degummed basis probably will account for a larger portion of the RBD basis than it has historically. I think that if I expect RBD basis to decline into the first quarter from, let's call it 19 cents down to 17.5 cents or so, something like that, maybe a little bit more, that then implies that crude degummed basis probably rises from where it is currently, which is 7 cents to sort of, if the refining margin gets down to, let's call it 5 cents, that would say that crude degummed basis would probably be about 12 cents. 12 cents for crude degummed basis sounds kind of crazy, I think, to me. I mean, done this a long time, and that's a relatively high basis, although you can see that we did get up to 15 cents in June during the first big run up in soybean oil prices. So it's not unheard of. The difference here would be that that the rise would be more sustainable, or it would, I would expect it to last longer. We're essentially changing from an equilibrium that was crude degummed basis 0, call it, and the refining margin of 3 or 4 cents to a long run scenario where crude degummed basis is probably significantly higher than it has been in the past, and maybe as much as sort of 10 to 15 cents on an ongoing basis. But the RBD, the refining portion of the RBD basis, shrinks down and gets back closer to that long run average. Now, again, I think that you probably don't get all the way back down there because you have less RBD basis available relative to RBD demand, even as the expansion in crushing and refining capacity moves forward. But because you're using up more crude, more of that refining capacity to produce crude, that the RBD basis probably stays a little bit higher than the long run average. Okay, so outside of that, I don't really have that much for you this week. I did get I got most of the charts and data on the website updated. The only thing that I haven't gone through and updated yet, and I will do that right after I'm done with this webinar, is the forecast for margins and RIN prices and LCFS prices. I don't anticipate significant changes in there, although we have seen a pretty sharp decline in energy prices over the past week or so. And I think I probably am going to lean more towards, at least in the short term, at least over the next quarter or two, probably weaker energy prices than I had been forecasting. But those probably are going to be offset by weaker feedstock prices as well, and maybe higher RIN values to keep margins high enough to kind of continue to encourage production, so that the biodiesel producers will continue to produce in the volumes that they've been producing to meet that gap in demand between ethanol production and the ethanol mandate that I have obviously beaten to death, and also the undifferentiated advanced mandate. The last thing I guess that I want to talk about this week is alcohol to jet. And so I think a couple of weeks ago I kind of mentioned, or maybe it wasn't on this webinar, but it's something that I've talked about with several people, that when we do our long-term forecast, one of the things we do is we go through and we sort of review our project list. And in the last iteration of that report, that was the first time that I started to sort of notice this ethanol to jet, even though ADM had made a significant announcement, or it announced plans to convert a substantial portion of their ethanol production capacity to ethanol to jet. And so I've started to look into this a little bit more, because it obviously has big implications for the renewable diesel business and the feedstock demand. If we're going to keep renewable diesel or biomass-based diesel production at its current level, whether it's renewable diesel or biodiesel, but if we keep that sort of combined production at its current level going forward, and then we start to add in a bunch of demand for sustainable aviation fuel, then the feedstock situation starts to get significantly tighter. However, if ethanol to jet actually works, and I don't mean can they do it from a chemistry standpoint, but does it make sense to do economically? Then there may be some relief on the renewable diesel feedstock demand side. So my initial thoughts about this, and I'll refine them, and then I probably will write about them in the coming weeks. But my initial thoughts about this had been that for ethanol producers to shift, they're giving up the value of the distiller's corn oil. I don't know that that's 100% true yet. I'm still trying to check that out, but let's just, for the sake of argument, let's say that it is true. So if they produce ethanol, they essentially get the value of ethanol, a D6 RIN, and the value of DCO. They get a couple of other little bits and pieces, and maybe potentially under the new Inflation Reduction Act, a significant amount of money for carbon sequestration or carbon oxide sequestration. They'll get that probably either way. But as I think about it, even if they lose the DCO portion of it, what they will get instead is they'll get the value of the sustainable aviation fuel. They'll lose the D6 RIN, but they will get D4 RINs for their production. So not only will the RINs be more valuable just on a one-to-one basis, but I think they'll get 1.5 RINs instead of 1 RIN. And then they'll also get the new blender's tax credit for sustainable aviation fuel. So just from that perspective, and again, there are some very key pieces to my analysis that are missing at this point. I'll be really frank about it. But just from that very high level kind of general perspective, it seems to me that jet to ethanol probably makes a lot of economic sense, or makes potentially more economic sense or more money than just producing ethanol and selling the DCO. One of the big holes in this analysis is that I don't know yet the loss in, or I guess the conversion rate from ethanol to jet fuel. I don't know if that's 1-to-1 or if that's 50% or 10%. I just don't know the number yet. I've done a little bit of looking, but haven't had time to really figure that number out. And that number obviously will be key, because for all of the benefits on the credit side that producing SAF has over producing ethanol, if the conversion rate falls below a certain level, those benefits are minimized, or they start to shrink. And so that kind of is going to be the key determinant. That said, I assume that the people at ADM are probably really smart and have probably looked into this in great detail, and probably haven't announced this shift in their ethanol capacity because it doesn't make economic sense. So I suspect that just generally it does make economic sense. And the question is the difference in profitability huge, or is it just sort of a couple of cents here and there? And that's what I want to try and figure out. Either way, it does seem like that while growth in sustainable aviation fuel is going to be really significant and is probably a key component to the margins for renewable diesel producers in the very long term, if you assume that eventually we will get a majority of sort of the diesel truck fleet, at least, and maybe trains, and maybe even ships, although ships seem a long way to me. But if you get all of that converted over to battery power, then sustainable aviation fuel is sort of the key driver if you think about where renewable diesel demand or what renewable diesel demand looks like 15 years from now or 20 years from now. If ethanol to jet makes that much sense, and you also assume that as electric vehicle adoption rates rise, or as the mandates from state governments like California banning the sale of internal combustion engines expand, then ethanol production probably, or ethanol demand probably continues to fall, because ethanol is used as an octane booster. Its use is directly related to gasoline demand in a very real way. So if a lot more cars are going to be powered by batteries in 5 years or 10 years, and you're an ethanol producer, you probably want to look around and try and find different ways to use your facility to continue to generate profits. And that means that that SAF is probably something that a lot of ethanol producers will consider, if not in the short term, certainly as more of the U.S. Fleet is converted to electric power. Probably more and more ethanol producers will start to look to SAF as a way to continue to operate profitably. The last thing that I'll say about this is that beyond sort of the economics of ethanol to jet and the RIN credits, the credit for carbon sequestration is a significant amount of money. And I know that there is a project underway because to do carbon sequestration, you need a fairly specific geological formation, or you need geology that will support carbon sequestration. And the Midwest doesn't have the best geology for carbon sequestration, and that's where most of the ethanol plants. So there is a pipeline that's being built that its purpose is to take carbon dioxide or carbon oxide into areas where the geology is more favorable for carbon sequestration. That amount of money, or the amount of money that ethanol producers will get for sequestering the carbon dioxide or carbon oxide that they generate, is really, really large. And again, they'll get this one way or the other, but it's something that is going to support the ethanol industry in a way that it had not been supported by the blender's tax credit. And so even as ethanol demand shrinks, and let's say that the economics for ethanol to jet aren't that great, or are only marginally better than just producing ethanol, the tax credit in the Inflation Reduction Act for carbon sequestration is something that will likely continue to support the ethanol industry for as long as it is renewed. Okay, that is the last part of me rambling. And now we've got some questions, so I will answer the questions. By the way, thank you for the questions. I always appreciate them. Can soybean oil futures delivery solve for crude to gummed basis? If the basis is bullish, futures should be bullish if delivery works. So this question is one that I spent a while trying to figure out about a year ago or so, because it seemed to me that when basis first exploded, it seemed to me that the most reasonable thing to do for a renewable diesel or a biodiesel producer was to take delivery from the CBOT and then have the crude degummed processed either at your facility if you had pre-treatment, or have it processed on a tolling arrangement from someplace else. And it turns out that the delivery spec for CBOT or CME futures is sort of one step shy of what you would need to be able to move the crude degummed from one location to another. Now, I think that, and when I talk to people on the energy side of the business about this, they kind of think that this is a relatively easy problem to solve. And it may turn out that that's actually true. The main problem is that if you don't do that step, if you just were to take delivery and try to ship whatever you take delivery of, that by the time that it got to you, it would be mostly gum instead of crude degummed. But there are heated tanker cars, or there are all kinds of ways that the energy companies, I think, could deal with this. And they are used to moving around things that are probably substantially more difficult to move around than soybean oil. All of that said, we haven't really seen the renewable diesel producers step into that market and take delivery in a big way. Now, that may change if basis really starts to run up again, and in particular, if crude basis really starts to run up. And so let's say that the refining margin still goes down to 5 cents, but crude basis goes up to 20 cents or something crazy. Then I think the incentives for the energy companies to solve that problem become that much greater. And I think that eventually I will not be surprised if we do get, if somebody doesn't crack that and starts to take delivery. I also think that the first time somebody does figure out how to take delivery and takes delivery of a significant portion of crude degummed, that will have a significant impact on the basis and the composition that we spoke about. So at the point that renewable diesel producers can start to take delivery, then crude degummed basis needs to fall down to whatever the cost of pre-treatment is, which I believe is probably, I think it's just slightly more than sort of the long-term average cost of RBD soybean oil, or the long-term average RBD basis. And so that would crack basis, and you would get generally lower basis going forward. That's what I think generally. I've spoken to a lot of people about it, and like I said, I get sort of, from the ag side, I get kind of, it's almost impossible to move the delivered product, and from the energy side, I get we've moved stuff that's much more difficult to move than that. And so there's that range of answers, but again, nobody has taken delivery. And so that's kind of what I'm waiting on to see how that part of it shakes out. When you purchase soybean oil futures, what is the relationship with the current basis for RBD and crude? How do the mechanics of the benefits of producing futures work? For example, if I produce futures for the near month contract, do I avoid paying the current premium over basis? So the futures part is kind of separate from the basis part. And the main reason that you buy futures, especially in soybean oil, is more just as a hedging tool, and much less because you want to take delivery of soybean oil. And so you don't, I guess I would argue that you would think about those two things sort of separately. For soybean oil, I tend to think about these things in grains, because grains is a little clearer to me, and it's a little bit it's obviously pretty easy to ship corn or soybeans or something like that. So typically the way that it would work in grains, and I understand that this is a little bit different, but bear with me here for a second. Typically the way that it would work in grains is you would buy futures as a hedge against your price, and then you would set up a basis contract with the elevator that you were actually going to buy the grain from. And then your basis and your outright price is hedged. You've got a fixed price, you know what you're going to pay. And when you take delivery, you either take delivery against the board, or more than likely you sort of unwind your futures position and then pay the price that you've agreed to with the elevator. So it will kind of work similarly for soybean oil. The only difference is, I think that again, the sort of option to take delivery from a CME approved delivery warehouse is limited for soybean oil. So it's not necessarily the fact that a futures contract will provide a hedge for your basis as well. And in fact, if you look at the correlation between RBD and futures prices, you can imagine that that correlation was really good up until April of 2021. But then that correlation broke down really badly. And I think that's always the situation where you are using a derivative contract that doesn't exactly match the underlying price risk that you have. So even in the case of soybean oil futures against RBD soybean oil, while the futures price will be a hedge, it still isn't an exact hedge for your price risk if you're buying RBD soybean oil. And that's why I've kind of had David on a couple of times, because I think that for a lot of my career, if somebody came to me with this issue and said, look, I've got RBD basis, or I've got RBD price risk, what's the best way to deal with that? I would have said, hey, look, just buy futures, and the difference between futures and RBD basis may move by 1/2 cent or a cent or something like that. Your price risk there is probably relatively limited. Now I think that that doesn't necessarily hold true. Now, it is broadly true that as basis rises, so do futures, or basis is a decent indicator of where futures prices will be, and often they move in the same direction. But the risk there is that even if they do move in the same direction, if the futures price goes up by 5 cents and RBD basis goes up by 15 cents, then you still have lost a significant amount of money. So again, I would kind of think of futures as a way to broadly hedge your price, but remember that you still have significant basis risk. And that is, and not to sort of really plug David that much, but that is why I think what David does can be important for a lot of people on this call, because the relationships that he has built will allow you to hedge your price risk with an instrument that matches with an underlying that matches your price risk. So hedge RBD soybean oil against the RBD soybean oil price rather than hedging RVD soybean oil against the crude price that you get from the futures market. Okay, I hope that was clear, but if not, send me an email and we can get on a call, and I'll even get David on the call and we can kind of go through it in a little bit more detail. At what point in 2023 do you see biodiesel and renewable diesel production surpassing 500 million gallons per month? That is a great question. And if you'll bear with me here for 1 second, I can tell you exactly when we anticipate that that will happen. Wow. Okay, here we go. So I'm just trying to find the rate. Apologize, I'm just trying to find the rate. Here we go. Domestic production 2023. So I don't know that we're going to, at least we're not projecting that we get there in 2023. We actually have sort of max production in 2023 at 419 million gallons. For 2024, let me just see something here really quickly. For 2024, boy, we don't really get there in 2024 either. We get to 410 because in 2024 you see a significant rationalization in biodiesel production, and that is partially offset by an increase in renewable diesel production. Beyond 2024, we've got projections for beyond 2024, but I think that I guess I would say it probably occurs in 2025, and I would tell you the exact month, except nobody wants to watch me sit here and kind of continue to do this. I would say that the total for November 2023 is 358, or our projected total is 360 million gallons, and then for December 2023, which is typically the peak month, is 420 million gallons. It may be that that production exceeds 500 million gallons at the end of 2023, or I guess a better way to say it is, if it's going to exceed 500 million gallons, it's probably going to be at the end of 2023. The other thing that I would note is that sort of, if we, I guess maybe a little correction to what I said before, if we don't get there in 2024, the shift from the Blender's Tax Credit to the Inflation Reduction Act credits in 2025 will have an impact on imports. Now, I think that ultimately the RIN prices will need to rise to a level to either dramatically increase domestic production, or to make the imports offset the loss of the Blender's Tax Credit for imports. And but I think that there probably is a period there in the beginning of the year, and maybe as long as the year, where import levels drop, and domestic basis has to pick that up. And so I think that that's possible, or I think that's probably almost assured at some point in 2025, but it will depend a little bit on that dynamic of the rise in RIN prices and how they offset both sort of the change in the value based on feedstock. So in theory, a reduction in soybean oil used as a feedstock, but also the reduction, the theoretical reduction in imports. But those things kind of line up to suggest that in 2025 it would happen. If not in 2025, again, I think there's probably some chance that it will happen in 2023. But our forecasts of late have tended to be a little bit higher than what has actually been realized. Very good question, though. Okay. There's a lot of talk about crude degummed soybean oil. How large is the RBD soybean oil market compared to the crude degummed soybean oil market? How easy is it to lock up RBD supply? I'll take the last part of that question first. I think it's probably pretty easy to lock up RBD supply. The question is, what price do you want to pay for it? And so I don't think it's going to be a situation where I think probably a year ago we were very concerned about sort of the refining capacity shortages and not having sufficient RBD supplies. Now I think that picture has probably changed, and I think again it's probably crude degummed is going to take up a larger portion of the overall refining capacity, but there still should be there's sufficient capacity for RBD, because RBD demand actually, we think, kind of peaks and then starts to fall after 24, 25, I believe is the peak, due to the fact that most of the renewable diesel producers have pre-treatment and will be buying crude degummed. In terms of the relative sizes of the market, I'm going to say off the top of my head that, and I'll tell you more in just a second because I've got a spreadsheet for that as well. The RBD market is probably, well, here we go. The RBD market is about, for 2021, we estimate RBD at 14.2 billion pounds, and crude degummed at about 5 billion pounds. But again, the RBD market is going to grow a little bit more, or maybe at least hold steady around that level, and then it's going to start to decline. And the crude degummed market is where you're going to see the bulk of the growth from the biomass-based diesel production feedstock demand. So while those are the numbers, or the estimates that we have for 2021, as you move forward in time, that spread narrows, and there may be a point, depending on how much sort of non-biofuel use you take out of RBD, there may be a point where crude degummed is actually a larger market than the RBD market. Do you see RBD canola basis behaving similarly to RBD soybean oil basis? EPA final rule have any wild change to that thought process? So in general, from sort of the composition discussion that we had before, I think that probably is something kind of similar happens in canola oil. However, there are a couple of differences for canola oil from soybean oil. And probably the biggest is that canola oil has a lot more non-biofuel demand and will continue to have a lot more non-biofuel demand, then it will have biofuel demand even after the EPA approves the pathway for RIN generation from renewable diesel production. And that's because if you think of sort of a hierarchy of fuel prices, or of vegetable oil prices or vegetable oil values, canola oil is near the top and certainly above soybean oil. And so you will tend to use more, and they have similar CI scores. So you'll tend to use more soybean oil in renewable diesel production, at least in the US. And then to the extent that that feedstock demand starts to take away from non-biofuel demand, at least in the food industry, you'll substitute canola oil into the food industry for the non-biofuel demand. For the feed industry portion of the non-biofuel demand, you'll substitute palm oil. So because of that, I think that that probably that refining margin remains a little bit stronger in canola oil than it does in soybean oil. All of that said, the spread between canola oil and soybean oil basically ran out to record levels last year and is starting to narrow already. And in the article that I started to write about canola oil, one of the things that I started to talk about was that the spread last year, the spread that we measure is not a great measurement because we essentially compare RBD in Los Angeles to crude degummed in Chicago or to soybean oil futures. But let's just say, for the sake of making the discussion a little easier, that spread averaged about 25 cents last year. And we expected the spread to average about 20 cents in 22-23. And we've already seen a sharp contraction in that spread in the last months of 21-22 because you've seen a recovery in canola production. And so you've seen crushing volumes for canola kind of pick up. Canola is harvested a little bit earlier than soybeans. And so canola crushing volumes have picked up more quickly than soybean volumes. So while that decrease right now would suggest that maybe instead of a 5-cent contraction in that spread, maybe it would be larger, maybe it would be 10 cents or whatever, I would kind of caution and say that right now canola is sort of a month or two ahead of soybeans. And so in a month or two, when soybeans are at their peak in terms of the seasonal crushing, then I think we'll get a much better sense of how much that spread can shrink. And so I'm not going to change my forecast quite yet, but if a month or two down the road we get to the peak in sort of soybean crush and that spread continues to really narrow, then I probably will shrink it down a little bit from where I'm projecting it right now, which is kind of 20 cents. And I think the long-term average for that particular spread is about 10 cents. I think there is some potential that maybe we get all the way back to 10 cents, especially if soybean oil inventories remain really ample and canola crush comes back and is at record levels in Canada and is really robust in the US, then maybe we get that spread back to its long-term average. But the main point there is that in addition to sort of that change in composition, which I think the decline in the refining margin for canola oil probably smaller than the decline in the refining margin for soybean oil, but you also have a decrease in canola oil basis relative to soybean oil. Okay, that will do it. As always, thank you so much for attending. I really appreciate it. Really appreciate the questions this week. I always enjoy your questions and always think that they're very helpful. I don't know at this point what's going to happen for next week. I'm probably 90% sure that we will have the webinar and everything will be fine. There is a smaller chance that that we could be out of power for a week or so, just depending on where the hurricane hits and how bad it is when it hits. If it looks really bad, then what I'm planning on doing is going to Miami, and so then I'll have power and things will kind of be normal. If it's a situation where it doesn't look that bad, but the power just doesn't keep kind of coming on, then there's a very small chance again that that I may need to that I will cancel next week's webinar, but I don't think that that is going to happen. And if I do, it would probably be sort of very last minute. So I will apologize in advance if I do that. I don't plan on doing that, don't want to do that. But if next week's webinar is canceled, you'll know that that is the reason. All right. Have a great week, everybody. And I look forward to seeing you again, hopefully next week, but if not, certainly the week after that.